Welcome to this week's Market Minute with me, Andrew Wilkinson, and my guest, Kevin Davitt, who is the head of index options content at the NASDAQ. Kevin, as ever, welcome back to the program.
Andrew, as ever, thank you for having me back.
I wanted to start with a headline from a midweek market wrap from no less than the Wall Street Journal, and it read, "Stock market today. Trump says 50% tariff on Brazil coming. NASDAQ rises to record." And as I scratched my head, I thought of one word for Kevin Davitt, which is discuss that headline, Kevin.
One word, very open-ended. What a difference a couple of months makes. Had we read these headlines, if you were reading the headlines in late March or April, the market reacted very differently, which to my ears is the heart of your question. So how do we explain record highs in early July and panic sell-offs in April? You're probably familiar with this thing, like the old Benjamin Graham saying, in the short run, the market's a voting machine, and in the long run, it's a weighing machine. It strikes me like this market right now is doing a better job of focusing on that long run and the proverbial kind of weighing mechanism. And we've become inured to those types of headlines. Now, yesterday was supposed to be the deadline following a 90-day pause, which was pushed out more recently for a number of trading partners. I think the bigger story is that the market has moved on, at least in the short term, from the threat of tariffs. Thus far, the impact of walked back tariffs has not been significant with respect to inflation data. And for the time being, the issue, be it with Brazil, where we actually have a trade surplus with Brazil, which strikes me as a more politically motivated tit for tat, given the relationship with Da Silva, who is now the president, and Bolsonaro, who was president. Now, we could be coming back here in a couple of weeks and saying, my, oh my, how things have changed. But to answer your question, right now, the market is not focused on tariffs. It's focused on Q2 earnings, which are right in front of us, and the prospect, given relatively favorable comps, for another good quarter. And I think that's explaining in large part how the market continues to reach new all-time highs.
So Nvidia this week reached 4 trillion in market cap. That's the first time a US company or any company has ever done that around the world. Let me ask you, how is technology leading the broad market, Kevin?
So that's a question that could have been posed at any point in the past decade. The leadership has shifted a handful of times over that window, if you're talking about a decade. But for the past, let's say since late 2022, Nvidia has been very much a focal point. As you mentioned, first company to reach that valuation. It is now the most significant constituent in both the NASDAQ 100 and the S&P 500. But when you look at the Magnificent Seven, which was broadly the focus last year, 2024, and for much of 2023, there has been much more significant dispersion in performance amongst that group of tech giants than there was in the previous 2 years. So the point there, we have seen Nvidia continue to outperform, and we have seen names like Apple and Tesla underperform relative to the rest of the group. I would argue that that is indicative of a more broadly healthy market. And then when you look beyond that at the sector level, there has been this year broader performance on the upside. We talked toward the end of last year about how concentrated kind of the growth of the broad markets was and how much it was driven by a handful of names. That has expanded this year, and that feels like a healthier market. Again, words I could be eating in a handful of weeks, but we will get a much better look at whether that is in fact the case during these Q2 earnings. And then what's sort of perfectly interesting about that is that Nvidia tends to report toward the very end of earnings season. And so we will continue to be able to talk about that powerhouse of a name that continues to outperform.
I wanted to turn the discussion to interest rates, where we've seen an increasing spat about policy. Should the Fed cut? Will it cut? Won't it cut? Will it cut sooner rather than later? How important do you think is the discussion, and what's your takeaway on monetary policy, Kevin?
So first of all, I'll readily admit that I'm by no stretch of the imagination a master of interest rates. I follow it at the macro level. I think one of the points I made in the first question about the market a little bit being inured to headlines like this could apply more broadly. And in this case, to the sort of rhetorical back and forth between Powell and some members of the administration. And administration always, or historically, administrations get a great deal of credit for when economies do well, and they arguably get too much blame when things go wrong, because there are just broad economic cycles that are going to play out independent of who happens to reside in the White House. Now, interest rates, as your audience likely knows, can act as an accelerant or a braking mechanism. And the administration wants to step on the gas. And the Fed historically has been independent of political regimes. They have their dual mandate. And it seems to me like the core of monetary policy seems committed to being data dependent. And I think that's a good thing for the markets long term. Short answer is it seems more headline driven, and investors seem to be discounting that back and forth rhetoric. Now, if we do get if we do get a replacement for Powell that seems more politically motivated, maybe that sentiment changes. But here and now, the market is pricing in somewhere between 1 and 3, with really the middle of that being 2 25 basis point cuts by the end of this year. That has been coming in more recently, given strong jobs data and the what's typically referred to as the terminal rate, the point at which the Fed will likely stop easing, has been rising. We'll see what shakes out. And that's always the case. If we talked 3 years ago about Fed fund futures and the expectation for hikes, the market was very wrong. And so it'll continue to be a point of interest. It certainly has an impact on the broad market. We saw that play out significantly in 2022. Here and now, the path ahead is one of easier monetary policy, and it's a question of by how much.
Kevin, thank you very much for your insights.
You're very welcome. Thank you for having me, Andrew.
Thanks to the audience for joining us. And remember, if you like today's episode, subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.